real estate is a long-term investment. What is happening in the short term does not mean that you should completely stop investing and that you should give up on real estate. Welcome to the Cash Flow Chronicles. I'm your host, Jonny and the founder of Catani Capital Group. For the last 2 years, I've been studying alternative assets and now help solve the problem of creating passive cash flow for creators, influencers, and busy professionals by bringing you 5 episodes a week of easy to understand education in the world of passive investing. What's up, guys? Happy Friday. Welcome to another episode of Friday Follow-Up here on the Cash Flow Chronicles podcast. I am your host, Jonny Catani, and we have made it through another week. We are rolling right through May. I hope everyone had a great first week of May. If you listen to my podcast on Wednesday, you know that this week was full of just chaos as another bank has gone down. First Republic Bank has bit the dust and officially bought by what is now the behemoth and lifesaver of the economy in JP Morgan Chase. And I wanted to wait to record this until the Fed had come out and done their meeting and announced what they're going to do. As predicted and, kind of what the market was anticipating, another 25-point basis hike. 25-point hike in the overnight rate, bringing it to between 5 to 5.25%, which was their target all along. However, some nuance to that. There was anticipation from a lot of experts that the Fed would pause after this, and Powell has not really given any indication there would be a pause. In fact, retracted some information from their March meeting that they would be exploring a pause and are. It's not that they're not exploring it. It's that they really have not seen the data that they would like to see to really, I don't want to say not discuss it, because they're certainly discussing it, but they're not definitive in that. Let's put it that way. They're not definitive in that they will pause after this, meaning when they meet again in June, they will absolutely be exploring another rate hike. In fact, 8 of the 14 members of the Fed committee are indicating, 7 of the 18 officials thought they might need at least 2 more increases. So what does this mean? Well, it means a few things. One, the economy is still very strong, despite bank failures. What's fascinating is they rely so much on the labor market and what's happening in the labor market. And what is happening that hasn't happened before is a massive transition and shift in the employment market, in the sense that 40% of baby boomers left employment, retired early during COVID. So what you had was this massive gap in employment. And so now there's something around like 10 million job openings available. And while we see all of these layoffs happening, right? You see it all over tech, especially a lot of layoffs happening because there's so many job openings. You're seeing those filled, right? And so in order for there to be this, unemployment's right around 3.6, maybe 4%, maybe. They really like to see anywhere from 6 to 8% to really indicate a recession and any kind of pause and or reduction in the rate. But it's not a normal labor market anymore. It's not your typical labor market. And so what they've done is they've had to adjust and are now starting to look toward other indicators, right? So obviously, they want to see inflation come down to 2%, which means consumer spending, that's starting to drop. Their goal is still to get it to 2% over time. It's fascinating to listen to them because it doesn't feel like they really have a clear direction, which is really what we've all been looking for, is what is your direction? What is it that you're going to do? And they're still like, well, we're waiting to see what happens. So we'll kind of see what happens over the next month in terms of the data that comes out. They believe that Q3, Q4 is when we'll really feel the effects of these banking failures. So they're really indicating that they see a recession and or slowdown really starting to happen in Q3, Q4, but still not a lot of indication as to what their plan is, which this increase was baked into the market. So stock market, indexes are actually up on the day because, again, they do their best to indicate what their goal is so that the market can prepare. And so things get baked in. The concern with real estate is you can't really bake that into real estate. And when it comes to lending, what ends up happening in situations like this, like I've talked about before, is lending tightens because interest rates are forward looking, meaning, lenders look to see what interest rates will be like, moving forward. And when there's no clear direction, it's easier for them. Well, I shouldn't say easier. It's not that they want to do this, but it helps staying conservative by just tightening your lending policy in order to avoid any issues on your balance sheet, which we're seeing are having a huge effect on these regional banks. So you could see lending tighten up even more. What this means for investors, it means that we still don't have a clear indication. It means that you're going to start seeing even more assumptions when they can be done, right? Obviously, most deals you're seeing are assumptions now. A lot of deals that locked in rates, 2, 3, 4 years ago still have 6, 7 years left on their fixed rate. Those are being assumed when at all possible. You're also seeing a lot more seller financing opportunities, a lot more groups exploring the creative financing route to get deals across the finish line and be able to pencil deals and get deals done. So by no means does this mean you should be sitting on the sidelines. It just means you need to, like I always say, just continue to, explore your options, explore your investment thesis, test your investment thesis, and explore your risk tolerance, right? And certainly tightening your risk tolerance is not the worst thing. If, it's not a bad thing to stick to stay rich investments. And what a stay rich investment would be what I talked about in other podcasts, a Class A brand new build, right? Brand new apartment complex. This is not going to get you rich, but it's going to keep you rich, meaning that you're going to get, maybe 6% preferred return with, a 16% IRR and like a 1.8 to maybe 2x multiple on the exit. Very solid, right? Hey, we're going to double your money in 3 to 5 years, possibly, with 5 years being very strong possibility. When it's an assumption, right? Let's say it's an assumption, there's not really going to be, a brand new build, you're not going to be able to assume a loan because it's coming off a construction loan. So you're going to see, long-term financing, you're going to see, higher interest rates, which means a lower preferred return and a lower equity multiple. But what that means is that your capital is going to be safe, right? So instead of sitting in cash and letting it burn, you put it into a deal like this, it stays safe for 3 to 5 years, and you come out of it, let's say you put 100,000 into it and you come out of it with 180,000 clean, safe, boom, and you're able to take that and move that into another deal. What that is a safe capital preservation deal, which allows you to feel confident that your money will be safe and there's a return in there. Is it a big, sexy 2.5, 3x multiple with an 8% preferred return? No, it's not. Are those deals around? Not really. Honestly, they're not really there. Even your value add deals are now turning into 2x multiples, which is not bad, you guys. You're talking about doubling your money in 3 to 5 years. That's not bad. All right. The stock market is not going to do that, especially now. Right. So you can feel very confident in those deals. But again, right, nobody's going to blame you for waiting, for sitting on the sidelines. Now, again, I want to make this clear. I'm not financial advisor. I'm not licensed. Please see your CPA or attorney to determine whether or not a deal is appropriate for you and for your risk tolerance. And so again, when I talked about the oil and gas deal, right, with the 3.5x equity multiplier and a 18 to 21% cash on cash return, past results are not indicative of future returns. So, while I strive to be up to date and provide accurate, up-to-date information, I make no representation or warranties of any kind, express or implied, about the completeness, accuracy, reliability, suitability, or availability with respect to the information contained herein. Any reliance you place on such information is strictly at your own risk. For making any legal, accounting, or investment decisions, you should consult with a qualified professional who can advise you based on your individual circumstances. We expressly disclaim all liability or any loss or damage arising from reliance upon any information contained in this communication. Why did I read that? Well, because I've gotten word from my attorney that it is very important that I give this disclaimer. In fact, you will see this disclaimer a lot more. I may be putting it into the intro of my podcast in order to CYA, cover your butt. You know what I mean? It's going to go onto my website and a lot more of my communications, because as we move forward and as things get murkier in the industry, you could start to see flags raised by investors, which means that it doesn't mean anybody's doing anything wrong. It just means that it's important for us as industry, quote unquote, leaders, experts, to cover ourselves, right? Because I'm not an advisor. And while I am still very bullish on the industry and, very much still looking for investment opportunities and will continue to invest, I don't want you guys to take that as advice. And, if something goes wrong, pin it back on me, right? You make your own decisions and you should consult those who are legally qualified to give advice in order to make that decision. And if you make that decision on your own, that's your own doing. So just want to keep that clear. So anyways, to conclude all of this with the Fed, we're not really sure what's going to happen. So we'll have to wait till June to see if there's any more clear direction. And, one thing to keep in mind too is just because if they do indicate a pause in June and do pause in June, that does not mean they're done raising rates. So again, unfortunately, the crystal ball is still very muddy and we'll have to wait to see what happens. But I hope everyone has great plans this weekend. This is not a bad thing, you guys. This does not mean real estate is a long-term investment. What is happening in the short term does not mean that you should completely stop investing and that you should give up on real estate. Now, I've obviously talked about other investment opportunities. That doesn't mean, right, like for me to bring an oil and gas deal or to bring any type of asset does not mean I'm giving up on real estate. It just means that I'm looking at other opportunities to invest, as you should as an investor. You should be diversified, which is why I really like the kind of poising myself and Katani Capital Group as private equity and not just commercial real estate, because it's important to stay diversified. Now, of course, you can diversify, and I've talked about diversification within real estate, but there are other assets out there. And while real estate is a bit stagnant right now, keep in mind that other assets may not be, which is why I presented that opportunity. So if you go listen to that, remember the disclaimer, I'm not an advisor and past results are not indicative of future performance. So Thank you guys so much for listening. I love this. These solo episodes are so much fun, and of course are my most downloaded. So I'm always grateful. Hopefully that helped you guys to understand what the Fed is thinking. We don't really know. And a lot of the questions, I actually watched the live Q&A with Powell. They're just watching the data like all of us and trying to determine what's best. Even with all of these bank failures, they still believe that, they need to tighten things up. So, that's going to force banks to tighten up as well, which means lending will tighten up. So we shall see. And of course, you guys know I will keep you updated as things move forward. Thank you so much for listening. As always, you guys go join the list. Big things are coming. The cashflowchronicles.com, the cashflowchronicles.com. Go there. You can join the list. And the video series is coming out soon. I'm very, very excited. And I look forward to bringing that to you. And I look forward to talking to you guys next week. Of course, remember, we are down to 3 days a week now, Monday, Wednesday, Friday. So Monday will be another amazing interview. Very, very excited on this one. Very, very knowledgeable. For all of my entrepreneur listeners, you will want to listen to Monday's episode. I'm not going to tell you the guest, but he is a very prominent business coach with an incredible resume. Very, very excited, especially if you're a newer entrepreneur. I kind of stayed to the new entrepreneurs, especially as I am one, ask some questions that pertain to me, as well as new entrepreneurs. So go listen to that on Monday. Of course, solo episode Wednesday and Friday, as always. And I look forward to talking to you guys next week. See ya. Thank you again for tuning in. Who do you know that wants more cash flow? Share this episode with them so you can grow your cash flow together. If you enjoyed the show, make sure you're subscribed on your platform of choice so you never miss a new episode. Go to katanicapitalgroup.com to learn more.